Good afternoon, everyone, and welcome to Accounting 102, Chapter 22, Performance Measurement and Responsibility Accounting. We're talking about measuring the performance of a business. A business generally has three kinds of departments, and they are cost centers, profit centers, and investment centers. Let's take a department store, for example. So a department store has profit centers. Now, a profit center is a department or division within the company that makes money for the company, generally through selling merchandise. So the shoe department, the clothing department, the housewares department, the appliances department, those are called profit centers. They earn revenue, they generate revenue. Now they also have expenses. Of course, the salespeople have to get paid, so that's an expense. There has to be heating and air conditioning and electricity in those departments. So they do have expenses, but they also generate revenues. So that's a profit center. Now, a department store like Macy's, for example, they also have cost centers. These are departments within the company that generate expenses, but they don't generate any revenues. An example of this would be the maintenance department. These people are responsible for maintaining the store. Custodians, repair people, people who just maintain the building, the payroll department. And then one thing that we're not going to talk too much about in this course is investment centers. They basically are there to take our excess revenues, excess money, and net income, and just invest it wisely. And so those are just some definitions that we're going to use in this chapter. We're going to be producing departmental income statements. We take this store, for example. They sell jewelry, they repair watches, and they sell clothes. And this is the space they take up in our building. Our building is 4,000 square feet, and the jewelry department is the largest part of this. And then there's also a jewelry repair department, like watches and stuff like that. It's a small room. It's only 600 square feet. And then the clothing department is also a part of our building. And this is the relative square footage. See how it comes to 100%? So basically our jewelry department, being 2,400 square feet, is 60% of our building. 2,400 divided by 4,000. Whereas the clothing is a fourth, is 25%. And the repair section is really small. And let's say we pay a monthly fee to the janitors of $800 a month to clean our store. Now, the jewelry department, the repair department, and the clothes department, they all produce their own income statements so that the store manager can see how well each department is doing. Are they making money for us? Are they losing money for us? Are their revenues greater than their expenses, etc.? So we will produce an income statement. Each of these departments will produce their own income statement. And it needs to equal the overall income statement for the whole store. One thing we're going to have to do is we're going to have to allocate the cleaning cost, which the departments don't pay the cleaners separately for their own departments. The cleaning company just gets $800 and they're paid by the store as a whole. But we're going to allocate that $800 to the various departments. Now, one way we could do it is just do it even. We could take $800 and just divide it three ways, right? Which would be $267. So we could allocate $267 of cleaning expense to each department. But the repair department would be really upset by that because being as small as they are, they don't require as much of the cleaning department's time as perhaps the jewelry department or the clothing department. So rather than allocate the $800 up evenly between the three departments, we're going to do it proportionate to the square footage that they take up. In other words, we'll take 60% of the 800 and allocate it to the jewelry department, whereas only $200 of it will go to close and $120 to the repair department. So this is just a method of getting this cleaning expense on the individual income statements. We can't just leave it off because it'll be on the overall income statement for the store as an expense, but it won't be on these. So the total won't add up to the sum of the parts. So we've got to get this $800 on these income statements. And we're going to do it based on relative square footage. So I've come up with an example for you. It's actually in the practice for chapter 22, and it's also in your homework. It's Quick Study 22-8. We have a company here who has 2 operating departments. Now, operating departments are profit centers. We will do an income statement for the mixing department and the bottling department. And what we have is maintenance costs of $200,000. So we need to allocate that to the mixing and the bottling. Of course, one way to do it is just do 100,000, right? Just split it evenly. But that is not going to fly because it looks like the mixing department takes a bigger portion of the building, 22,000 square feet, as opposed to only 18,000 for bottling. So we're not going to go with that. We're going to base it on square feet. So mixing takes up 22,000 square feet and bottling takes up 18,000 square feet. So basically, what percent is it of the total? Just take 22 divided by 40. You can leave off the zeros if you're doing division, right? So 22 divided by 40, whereas, and I don't even have to do that because I know that the rest of it's going to be 45%, right? So 55% of the building is mixing and 45% of the building is bottling. 55% of 200,000. So over half of this is going to be going to the mixing, see, 55%. And the rest of it will just go to bottling like that. You can do 200,000 times 45% if you want to, but you're going to get 90,000. Now, you don't always use square feet. So I'm not going to do this problem. I'm just going to show you real quick. In this one, we had advertising costs. And advertising was 100,000. And this advertising benefits all 3 departments. Let's just say, you know, shoes, clothing, and housewares. But advertising isn't really about, you know, cleaning up an area or anything like that, or utilities. So it makes more sense to allocate advertising based on the sales numbers of each department. Because if you think about it, advertising helps sales. What is this? This is 800,000, right? So it looks like half of this advertising cost will go to Department 2 because they had half the sales, see? So 50,000 to them. So anyway, my point is, it's not always going to be square foot. Lucia Company has 2 service departments. Now again, service departments is synonymous with a cost center. These departments service the company, but they don't bring in any revenue. The office, which does all the administrative work, you know, perhaps the accounting, the bookkeeping, and the reception, they're very necessary, but they don't bring in any money. The money's brought in by the books department, the magazines department, and the newspapers department, because we sell books, magazines, and newspapers, and this is what the money we get. And then the purchasing department, they're responsible for purchasing, you know, the raw materials for us. So they're very necessary, but they don't actually generate revenue. The office, they cost us 24,000. And the purchasing department costs us 34,000. Now we base, it says expenses for the office are allocated based on sales. For purchasing, we're going to allocate the purchasing of 34,000 to these 3 departments based on number of purchase orders. So since the books department uses the purchasing department more than the other 2, we're going to allocate more of the purchasing department's 34,000 to books, as you can see here. And actually, it looks like since we're basing the office on sales, it looks like also more than half of the office expenses will go on the books department's income statement too. So we're really hitting books hard, aren't we, with these expenses? But they do have a lot of sales, so I think they can handle it. This is office. This is purchasing. Let's keep them separate now. So the allocation base for the office department, I think we said it was sales. And then for purchasing, we're basing it on purchase orders. I'm going to go ahead and fill out both concurrently. Purchase orders, not, well, okay, number of orders. I guess that's what they mean. Now, what are the sales for these three departments? Well, they're right here. And for the number of orders, here are the numbers, 516. I believe I'm smart enough, and I think you are too, to just do that divided by that and get the percentage. Well, they're really making us spell it out, aren't they? The denominator is 900,000. Numerators 207. So yeah, over half of the sales are from the books department, as we suspected. Now the cost to be allocated, the office cost us 24,000. This is the expenses that we're going to allocate to all departments. 55% of it's going to books. That's 13,200. 22% of that is that, and 23% of that is that. So yeah, that's the whole 24,000, and it's being allocated to these three departments. So 13,200 will appear on the books department's income statement as an expense. And these will appear on these departments as office expense. Now, as far as this goes, I don't even think I need to do this for you. Waste of time. And the cost for the purchasing department, (43% of 34,000. All right. Number 10 has a little twist in it. Gomez has two service departments. Now, these are cost centers. These don't make us any money, but they cost us money. Personnel, which is HR, and the administrative office. And two operating departments, shoes and clothing. These actually bring in revenue from selling shoes and clothing. Following are the direct expenses in square feet, blah, blah, blah. There's your information. Now, in addition to all this, we have a utilities expense, and it's $64,000, but it's for the whole company. So again, we need to allocate that utilities expense to the various departments. But obviously, yeah, shoes is the biggest department, so they should get most of the utilities. So yeah, the first part is utilities. So we're going to allocate utilities based on square feet. So 14,000 square feet is what our total building is, I guess. Okay, good. And the denominator is the total square feet. That's the percentages, and the utilities expense is 64,000. So there we go. And just do your multiplication out. So that's my total 64,000 allocated to the four departments. Now, that's all well and good. But here's the deal. At the end of the day, I want how many income statements. So I want an income statement for the overall company, of course, showing everything all in one income statement, all combined. And that's easy. We've been doing that since Accounting 101. What I also want is I want an income statement for the shoe department and an income statement for the clothing department. I do not want an income statement for personnel or office, because there would be no revenues on it, because these two are service departments. They don't generate any revenue. So it would be pointless to show an income statement for these two departments, because it would always be a loss because they never make any money. So what we're going to end up doing is we are going to allocate everything to shoes and clothing only. Now, here we have allocated some utilities expense to shoes and clothing, and that's fine. We don't want this 5120 going to personnel and office. Eventually, at the end of the day, we don't want that. Personnel expense allocated based on, can you tell me that? Okay, number of employees. And the office expense. Now, the number of employees for shoes and clothing only are, the denominator is 12, of course. Okay, so 75% personnel expense. So how much personnel expense do I want to allocate? Here's the kicker. This is a good question. How much personnel expense do I want to allocate to shoes and to clothing? Where's the personnel expense? 18,000, right? Okay. That's what you put. Cool, right? I know you don't know where I got that. Or maybe you do. So most people would put, yeah, personnel had 18,000. We want to allocate that to shoes and clothing. That's true. But don't forget, up here, we also allocated 5120 of utilities to personnel. So down here, we have 18,000 plus 5120, which is the 23,120. My point is, I don't want any of this utility expense going to personnel or office. It's all got to end up going to shoes and clothing. What is that? 23,120 times 0.75, 17,340. 5780 is the other. And the same thing we will do for office expense. So again, the allocation base is sales. So that's going to be 273 and 77. All right, so basically 78% to shoes and 22% to clothing. Office has 25,000. See, office expense. Office has 25,000 of their own, plus the 6,400 that office got from utilities. 31,400. And 78% of that is 24,492. And 22% of that, of the 31,400, is 6,908. Let's do this one. I'm going to ask you a question. Should we eliminate the ski department? One of the things we're going to do in this chapter is evaluate departments. A company needs to always be evaluating the various departments within the company and determine maybe we should get rid of this division. They're losing money for us. But maybe other divisions are making money. So here we have the ski department, and we do hiking and skiing and other outdoorsy kind of things, but we have a ski department, and we had sales of 605 and cost of goods sold of 425, and then some other expenses. Let's do a departmental income statement. Obviously, we're always going to start with sales, aren't we? And the sales were, I believe, 605. And of course, we take out cost of goods sold. The cost of that stuff we sold was 425. So right off the bat, we got a gross profit on the inventory of 180. So that's pretty good. Then we have these expenses we got to take out. Now, the ski department has people that make salaries and they have depreciation. So let's go ahead and take that out. If we were to get rid of the ski department, we would be getting rid of this profit, wouldn't we? But we would also be getting rid of these expenses, 112 and 42. And then we take out the indirect expenses, rent 14,000, office 20. So it's a loss. Okay. Let's check our work so far. Make sure we got it right. Okay, that's good so far. Now, you would look at this and say, ooh, ski department's got a loss. Let's get rid of it. But hang on a second. I'm here to tell you that that would be not well thought out. Certainly, if we got rid of the ski department, we would lose this profit. But look at these expenses. There's so much more, right? But wait a minute. Would the rent really go away? This is an indirect expense. I'm here to tell you that if we got rid of the ski department, we would still have to pay rent on the entire building. This 14,000 would just end up being allocated to the other departments. So getting rid of the ski department would in a way hurt the other departments because we would have to allocate this portion of the rent that ski was taken on to the other departments. Okay. That rent's not going away just because we eliminate the ski department. We still have to pay rent on the whole building. Now you're probably thinking, well, maybe we could sublet out that section of the building. I don't know, maybe. But let's assume it's all one big building and we can't just stop paying rent on that part of the building. And also this, the main office of the store has huge office expenses, and we are being allocated 20,000 of that. But if we get rid of the ski department, the office is still there. We would just have to allocate this 20,000 to the other departments again, which would hurt them. So what we do is a departmental contribution to overhead report is kind of like an income statement, but it only focuses on the revenues and expenses of the actual department itself. Let me show you how this is going to work. 605, 425. Now the salaries, those are direct expenses, salaries, and then depreciation. That would go because the equipment would probably go. Total direct expenses is those two is 154. So my departmental contribution to overhead is 26,000. Point is, it's positive, folks. It's positive. What this is saying, if you'll just hang with me for just a second, this ski department has a gross profit of 180 and expenses of 154 on its own. So it's got a positive net income coming in, just taking itself isolated. This 26,000 is going to contribute to the business's overhead overall. It's positive by 26,000, and that money is going to help fund the rest of the business. Departmental contribution to overhead. So we're contributing $26,000 to the business. So based on that, I don't think the ski department should be eliminated. So when you're looking at eliminating a department, don't just do an income statement and allocate all these indirect expenses that are still going to be there if we eliminate the ski department. You've got to do a departmental contribution to overhead statement and just look at the direct expenses. If they're positive, it means they are helping the business. They're pulling their weight. They're helping contribute to the business's success. That is the entire chapter. I did skip a few, but the ones I skipped are just very representative of the other questions.